In this video, I will show you a simple trick that you can use to find strong market pullbacks that have a high probability of success. The sole purpose of making this video is to help you understand how to identify strong pullbacks. But before we start, be sure to hit that like button and subscribe to our channel so that you don't miss on any of our new videos. With that being said, let's get into today's video. When the price trends in a certain direction, it does not move in a straight line. Instead, it moves in a zigzag pattern by creating higher highs and higher lows. In a downtrend, we see that the price makes lower highs and lower lows. The moves that occur in the direction of the trend are called as impulsive moves. And the moves that occur in the opposite direction of the trend are called as corrective moves. Corrective moves can be also called as pullbacks. Our job as traders will be to identify such corrective moves and trade in the direction of the trend. We will use two indicators in this strategy and combine it with price action to determine powerful pullbacks in the price. The first indicator is the moving average indicator. If you watch my videos, you know how much I love the moving average. In this strategy, we will use the 200-period moving average to identify the direction of the trend. So when the price is trading above the moving average, and the 200 EMA is sloped upwards, the price is said to be in an uptrend. In an uptrend, we will look for buying signals only. On the other hand, if the price is trading below the 200 EMA, and the EMA is sloped downwards, the price is said to be in a downtrend. In a downtrend, we will look for selling opportunities. The second indicator that we will use in our strategy is the RSI indicator. The RSI indicator is called as the Relative Strength Index. RSI is a momentum indicator. It shows the relative change in price over the last X number of candles. The value of the RSI moves from 0 to 100. When the RSI is trading above 70, the price is said to be overbought. In an overbought condition, we can expect the price to make a down move. And when the RSI is trading below the 30 level, it is said to be oversold. In an oversold condition, we can expect the price to make an up move. But this is something very basic, and it does not work all the time. In fact, most of the time, we see that the price stays overbought and oversold for long periods of time before actually making a reversal. So, how should we trade the RSI? A more advanced approach will be to look for divergence. Now I know there are a ton of videos out there on the topic of divergence. Most of those videos show us how to trade the regular divergence. But in this strategy, we will not use the regular divergence. Instead, we will use the hidden divergence. To understand hidden divergence, we first need to recap what a regular divergence. So a regular divergence is of two types: a bullish divergence and a bearish divergence. A bullish divergence is when the price makes a lower low, but the RSI makes a higher low. This is a sign that the market has lost the bearish momentum and the price is ready to shoot up. On the other hand, a bearish divergence occurs when the price makes a higher high and the RSI makes a lower high. This shows that the price might have lost the upwards momentum. Hence, we can expect a down move. Now, the regular divergence is a great way of spotting potential reversals. But what do we do when the price is trending? This is where hidden divergence comes into the picture. Hidden divergence can help us in identifying strong pullbacks in the price. Now let's understand the hidden divergence. So the hidden divergence is also of two types: bullish hidden divergence and a bearish hidden divergence. A bullish hidden divergence occurs when the price makes a higher low and the RSI makes a lower low. Similarly, a bearish hidden divergence occurs when the price makes a lower high, but the RSI makes a higher high. Here is an important tip. I would never suggest using hidden divergences alone to trade. Instead, I ask you to combine them with other elements of technical analysis to create a logical trading system. We will use the 200-period moving average and combine it with hidden divergences to identify pullbacks that have a high probability of success. So here is an example. Here we see that the price was trading above the 200-period EMA, and the EMA was also sloped upwards. This was a perfect uptrend. So we will be looking at buying opportunities. In an uptrend, we will only focus on bullish hidden divergence, and we will ignore any bearish hidden divergence. Here is a strong bullish divergence. Here we see that the price makes a pullback in the uptrend. We notice that this low is higher than the previous swing low. So we can say that the price has made a higher low. At the same time, the RSI tells us a different story. On the RSI, we see that the current value is lower than the value at the previous low. The RSI has made a lower low. This is a bullish hidden divergence. The price has made a higher low, while the RSI has made a lower low. So we will look to buy on this candle. The reason we buy on this candle is that we see a small-sized hammer candle that appears after a big bearish candle. This indicates that there has been a sudden stop to the selling pressure. So we buy on this candle. Now we will keep our stop loss a few ticks below the most recent swing lows. And we will place our targets near the most recent swing high. As you can see, the price gradually moved towards our targets over the next few candles. Now let's look at a sell trade. Here we see that the price was trading below the 200 EMA, and the EMA was sloped downwards. We can also see that the price was making lower lows and lower highs. So we were in a strong downtrend. In a strong downtrend, we will look for selling opportunities. This means that we want to look for bearish hidden divergences, and we shall ignore any bullish hidden divergences. So here on this candle, we see that the price made a strong pullback. At this point, we can see that the close of this candle was clearly below the most recent swing high. Therefore, we can say that the price has made a lower high. At the same time, the RSI shows a different picture. The value of the RSI was much higher than its value at the previous swing high. So, the RSI has made a higher high, while the price has made a lower high. This is a perfect selling opportunity. So we look for candlestick patterns. Here we see an inside bar candlestick pattern. The range of this candle is completely inside the range of the previous candle. So we sell on this candle. We can keep our stop loss above the most recent swing high, and we can place our targets at the nearest swing low. And as you can see, the price gave a perfect down move after our entry. Now, let's add support and resistance to this strategy and make it even more profitable. Support and resistance levels are simply powerful tools that can help you create profitable systems around it. So here is an example. Here we can see that the price was trading above the 200 EMA. So we are in an uptrend. The price makes a strong up move here, then it pulls back. So we mark this level as a point of resistance. Then, the price makes another up move that breaks the resistance level. And finally, it pullbacks to the exact resistance level. The resistance level has now turned to support, and therefore, we expect the price to make a higher move. At the same time, we see that the price has made a higher high. But the RSI has made a lower high. This means we have identified a bullish hidden divergence in an uptrend. The divergence also coincides with a strong area of support. This creates multiple confirmations on the trade opportunity. So we buy on this candle. We will keep our stop loss below the support level, and we place our targets at the near swing high. The price achieves our targets in a couple of sessions. Now let's look at a sell trade. So here, we see that the price was trading below the 200 EMA, and the EMA was sloped downwards. This shows that the price was in a strong downtrend. Now, in a downtrend, we want to look at bearish hidden divergences only. If we look at the price action, we see that the price made a strong down move here. Then it pulls back. So we mark this level as a support level. Next, the price makes another down move and breaks the support level. So the level has now become a resistance level. Then the price makes a pullback and comes near the resistance level. At this point we notice that the current price was below the most recent swing high. Therefore the price has made a lower high. At the same time, the RSI has made a higher high. So this is a bearish hidden divergence. So we have identified a bearish hidden divergence that has occurred in a downtrend, and it also coincides with a strong level of resistance. This gives us a multiple confirmation for the trade. So we will sell on this candle, and we will place our stop loss above the resistance level. We will place our targets near the most recent swing low. As you can see, the price gave a down move after our entry. That brings us to the end of this video. If you liked this video, then be sure to hit that like button and subscribe to our channel, so that you don't miss on any of our new videos. See you in the next video.